we are looking at strategic tax planning, and that is the chapter 3 of the book. And in the old syllabus, this part used to be 60 marks. So everything is inside there. So it starts the 60 mark aspect of the tax syllabus. All right. So, and it is strategic tax planning. Now, as you can see, we start by talking about the concept. It's called strategic tax planning. So we are looking at tax planning. All right. Now, strategy simply means action plan. It's a course of action. And by that, you are taking a course of action just to have competitive advantage. So these are things you learn in case study. Competitive advantage. All right. Now, what is tax? Tax is a cost to business because it forms part of the expenses of every business. Again, tax, though it is a cost to business, is a revenue to the government. So that is the issue. That is the contracting issue that we need to deal with. Now, what is planning? Planning simply means that you are organizing yourself to fulfill an objective. So that is that. So when you combine these three things together, what you see is that strategic tax planning is just a course of action, a planned cost of action to actually reduce your tax liability, to reduce this cost. All right. So the course of action that you put in place, the strategic cost of action that you put in place, the organized cost of action that you put in place so as to minimize your cost, because that is the goal. Every entity wants to make profit. Every entity wants to make profit. And the more you minimize your cost, the more your profitability. But the government is not going to sit aloof because it is a revenue to him. So that is that. So these are the issues there when it comes to you dealing with strategic tax planning. So basically, that is that. So all the things you put in place, restructuring your activities, your transaction, in such a way that you reduce your tax liability or increase your tax savings. All right. So that is that. There are basically 4 principles of tax planning. There are basically 4 principles. Principle number 1 is trying to defer your tax liability without generating interest or penalty. That is the first one. In Ghana, this thing doesn't really seem like you have planned something, but elsewhere it does. Why? Because if you're able to defer the payment, all right, of your tax, that means that the money can be with you, but you'll be paying later. And the fact that the money can be with you and you'll be paying later means that you can save the money for a point in time, get some interest, then later on go and pay your tax. So basically that is that. So in section 47, subsection 1 provides that you can actually write to the CJ, Commissioner General, for an extension of payment of tax. All right. If you do that, then it means that you have not paid, neither will you also suffer a penalty or an interest. So that is that. So basically, you can extend it, and by that, you will be able to maintain your, cash flow and get some interest on it. Now, there are, after this, we will talk about some, all right, we will talk about some concepts because there are some concepts we need to understand, like what is tax planning, what is tax evasion, what is aggressive tax planning. We will come back and deal with the concept. Now, so basically, if you say you want to plan your tax, then it means that you've been able to defer your tax payments without suffering penalties. All right, so basically that is that. Now, If you're able to do that, the law actually provides that you can actually redo that and you can have a maximum of a period not exceeding 12 months. But I mean, if you even had 6 months, you can invest the money for half a year, get something. So the benefit is to synchronize your cash flows. Maybe you don't have the money yet, you can get it. You can also invest the money to offset the interest on the tax that you are paying. So if, let's say, your tax liability was 50,000, and this 50,000, you invested it for 6 months, and maybe you get a rate like 20%. What is 20%? 6/12 by 50,000. Yes, how much will you, get, please?
$6,000.
You get what? 6,000.
Yeah.
12,000.
Please, can you give me correct answer? Punch calculators and give me correct answer. Me, I think it should be around 5,000.
It's 5,000.
Yeah. So if you're able to save 5,000 out of this transaction, that means that basically you are paying 45,000 as your tax, because the same money you would have paid and not have a savings of 5,000, you have saved something. So that is something you can do. All right. As for GRA, the moment you show commitment, or you show you are committed to a liability, and they know that very soon the money will come, so they can actually do it into their system. So basically, that is that. Another principle of tax planning is the ability to change location of an income. All right, ability to change the location of an income. So, like we all know, if your business is a manufacturing business, for example, manufacturing business under the Income Tax Act gives a location incentive. And it says that if you are located in Accra, Tema, the tax rate you pay is 25%. If you are located in any other regional capital apart from Accra, Tema, you'll be paying 18.75%. That means you have gotten a rebate on it. All right. But if you are in any place other than regional capital, then what you'll be paying is 12.5%. So it means that by principle, if I'm able to change the location of my income, I will be able to save, given this, I'll be able to save 12.5%. So basically, these are avenues, these are principles. So timing difference is part, changing the location of the income to is part. Then we have ability to change the character or the attribute of an income. I always say this, a popular quote by my own boss, Dominic Knapp, that will say that tax in the hands of the church, money in the hands of the church is called offering. Money in the hands of a businessman is called taxable income. Money in the hands of an NGO is called donation. So if you're able to change the character of the income, then it means that you'll be able to dodge tax, because the church offering money is not taxable. The NGO donation money or charity is not taxable, but the business profit is taxable. So the ability to change the nature or the character of the income also affects the taxability of it. So for example, it is said that if you invest in treasury bills are non-taxable. If you plow back your profit to expand your business, that one too, you'll be free from tax, especially when we are talking about NGOs like schools and universities and those. All right, so basically that's that. Then the last one is the ability to transfer a transaction from one person in a low tax from one person in a high tax jurisdiction to another who is in a low tax jurisdiction. All right, because if the tax at the various places are not the same, such that let's say an agro processing transaction from Accra to Bolgatanga, the tax system in Bolga is different from the tax system in Accra. So in terms of location, and we'll be looking at those things right now. So in terms of that, you know that you have been able to save yourself some tax savings. All right. So basically, that is that. These are the four principles. These are the four principles: ability to change the location, ability to defer without suffering interest, character change, then transfer the transaction from a person in a high tax jurisdiction to another person in a low tax jurisdiction. So basically, that is that. All right. So now, if you have a question, please, you can ask. Now, let's look at these three concepts, because it's an often asked concept. One is tax avoidance. Then we have aggressive tax avoidance. Then we have tax evasion. What is tax avoidance? Tax avoidance means that you are using legal means to reduce your tax liability. It is legal. It is legal. So you are taking hold of exemptions that are in the act to reduce your tax liability. Now, it is meant to be bending the law, but not breaking the law. So it's like holding a cane, then you bend it. You are not breaking it. You are just bending it. So tax avoidance is bending the law without breaking the law. You are doing your planning in the confines of the law to reduce your tax liability. Section 34 of Act 896 basically says that tax avoidance includes any arrangement. The main purpose is to avoid or reduce your tax liability. So that's how the law defines tax avoidance, that it is any arrangement, the main purpose of which is to reduce your tax liability. All right, so basically that is that. And there are so many ways of going about it. So it's just using legal means to avoid tax payment, all right, or reduce your tax payment. Then we have aggressive tax planning. In fact, with this one, there is a popular quote by this Judge Leonard Hunt, and it is a quote that I love quoting. It's a simple quote. It says that there was a case between the commissioner versus Newton in 1947. This is in UK. And the judge says that over and over again, the courts have said that there is nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everybody does it. The poor man does it. The rich man does it. Nobody owes any public to pay more taxes. All right. So that is that. To pay more taxes as enforced enactment, nor voluntary contribution. The voluntary contribution. This means that you can't tell a person to morally pay tax. No, you can't just do that. And it says that to demand more in the name of morality is a mere cant. So, like, for example, not long ago, there was e-levy, which is on Momo, right? On Momo. Asking me to do Momo just so that you can have tax money and say that is what you are using to construct road. It's a mere cant. If I can avoid Momo transaction, I will avoid Momo transaction. So it's not by force. It's not by force. So basically that is that. And there are so many things we will be discussing. We will discuss all these issues in here. So then we come to aggressive tax avoidance. You know, aggressive tax avoidance, the simple way I can actually explain it to you is that you are using legal but unethical means. Unethical means. It is legal, but it is unethical to actually avoid tax paying. It is called circumventing the intent of the tax law. So, like, we know all laws are supposed, we normally say the letter of the law, the spirit of the law. But this one, you are using the letter of the law to you circumvent it to your own advantage. So what is happening is that it is a practice or strategy that aims at reducing or eliminating tax liability in a way that is considered outside the boundaries of what is a normally accepted reasonable tax planning activity. So let me give you a typical example. Now, in this example, this is what is going to happen. So, like I'm saying, a typical example that I can be given will be like, let's say, let's use the NGO system. So, operating an NGO that is actually financing loans. It's actually financing loans, taking interest, but it's an NGO. So it's too aggressive. All right. And like I said, it is not frowned upon by the Tax Act, but the Commissioner General does not welcome it at all. But as for tax evasion simply means you are using illegal means to actually avoid tax payment. All right. And so Plato said that where there is income tax, the just man will pay more and the unjust man will pay less on the same income amount. This one suggests that there is somebody who is evading tax payment. All right. So basically, that is that. All right. So that is the concept that you need to understand. But herein, we come to discuss the maxims of tax plan. Maxims of tax plan. Maxims. There we use the late variable, and it is going to take a while. All right. We discuss the late variable, where L means location or jurisdiction. A means activity, what you can do. T means time, and E means entity. So we are going to look at these four variables and discuss them. These things seems like things you need to memorize. Yeah, you need to really memorize them, sort of, to be able to grab them for answering in your exam. So that is how it looks. Now, the first one that we're going to look at is the location variable. Where can I locate my business to benefit from tax planning? And the first location that we are going to look at, which is always examined, is the free zone. We're going to look at the free zone. Now, the free zone has so many benefits. It has so many benefits. Now, if you look at the free zone, these are the incentives available for the free zone. Now, Section 28 of the Free Zone Act says that the free zone developer and the enterprises are exempt from income tax. So, one, they are exempt from income tax for 10 years. Please, the word is income tax, not tax. It's income tax. So don't say freehold does not pay tax. Please, they don't pay income tax for 10 years from date of commencement. If you say they don't pay income tax, they don't pay tax, there are some other tax types they may pay, but those are not income tax. So from the date of commencement, take note of that. So that is that. Then after the 10 years, the chargeable income from their exports is taxed at 15% after 10 years. So as you can see, chargeable income is taxed at 15%. And you can reference that in the paragraph 4 of the first schedule of Act 896. Then so the export is taxed at 15%. Then the domestic ones are also taxed at 25%. All right. So basically that is that. So at most 25%. But you see, they are also regulated in such a way that 70% of their sales can be exported and 30% in the local market. So they should be there doing more export so that Ghana will get foreign exchange. All right. So basically that is that. Now there's a case I want us to discuss. It's a case that is interesting. It's there is an activity variable. We will get to that. But just a quick one. The law says that a non-traditional export, a person who is in an activity of non-traditional export, all right, is supposed to pay tax at 8%. That is what the law says. That is what the law says. Now look at this. A free zone developer, and this is a tricky question, so let's see what you think about it. A free zone developer, after 10 years, is in non-traditional export. And so the free zone developer, we said that his export is taxed at income tax from export is 15%. And he was and if he non-traditional export activities is to pay 18%. A free zone developer was in an export activity of non-traditional exports. And so he decided to apply a tax rate of 8%. Do you think he's allowed to do that, or he's supposed to actually apply the 50% since he is exporting? By law, their export is supposed to be 15%. So yes, what do you think? What do you think?
I think he can apply the 8%.
Why?
Because after the 10 years, even though it says that 15%, but the other non-traditional exporters pay a tax of 8%. So he also falls under the same category as them.
So he can apply the 8%.
Yes.
So do you know the particular example of the concept this one fall under? Is it tax planning? Is it tax evasion? Is it aggressive tax planning?
I'll say tax planning.
You put it under tax planning. Okay.
Yes.
Yes, who else? Anyone else?
I think it's right. In terms of the 8%. Although
Your line is not good at all.
15% after the 10 years, non-traditional. So the 8%. Oh, it's still bad.
Yeah, it's better now.
Okay. I was saying that though they are supposed to pay 15% tax after 10 years, but since they found themselves within the confinement of the non-traditional activity, they will have to pay the 8%. And also I see that to be a tax avoidance, because we said that tax avoidance could also mean where you make arrangement in order to reduce your tax liability.
All right, that's fine. So the case was that the case was adjudged that the free zone developer is to apply the 15%, and the non-traditional export apply to non-free zone people. So that's how the case was adjudged, and it has become a law. So even though you are a free zone, if you're a free zone and you are doing 15%, even if you are doing a non-traditional export, you are still supposed to apply 15%. So that is the judge's judgment on the issue. Then this was the case law, Blue Sky product. I know you know Blue Sky, right? You know Blue Sky?
Yes,
Mm-hmm.
the ice cream.
Yeah, they do drinks. Yeah, uh, so it's that was the adjudication. So you see, it has become a law now, and that is what it is. So the 8% is for purely non-traditional exporters, not free zone developers. All right. So basically, that is a nice question you can ask to actually go about it. All right. So that is that. So the free zone people, this is their tax issue. But not only that, this is the part that you have to be careful about, because the part that we did is about the free zone business. Now watch this. If you as an individual wants to invest in free zone, these are the opportunities available for you. The shareholders are exempt from withholding tax on any dividend that is paid to them from their freehold investment. So sometimes the question is like, somebody wants to invest, discuss the avenues where the location he can invest in. So free zone becomes one of them. That is to the shareholder, not the business. Please understand the differences. The free zone business, we said that they don't pay tax for 10 years from date of commencement, income tax for 10 years from date of commencement. And again, we also said that after the 10 years, 15% tax rate applies to their export and 25% apply to their domestic trade. And again, they are also supposed to export 70% of their things and trade 30%. So those are the things we discussed. But the shareholder is exempt from withholding tax. VAT rate for free zone is zero rated. So that is that. Free zone, zero rated doesn't mean they don't charge VAT. It means that the VAT on them is 0%. So that is that. And there is minimal custom formalities. Again, you are exempt from taxes on import and export, and transactions between free zone enterprises are also exempt from duties and VAT. So these are the tax issues that you can see there. Of course, we should also understand that both foreign and domestic investors can take a maximum 100% shareholding. All right, and you are guaranteed your transfer of money outside Ghana, because sometimes some people are not guaranteed the transfer of their income outside Ghana. But this one, free zone, you can actually do it. So this thing allow a foreigner to actually come in, invest in free zone. He is not restricted from transferring money outside Ghana for the investment that he did. All right. So basically, that is that. In a dispute consideration too, you are allowed to do it at the international trade law. So arbitration of the United Nations of International Trade Law. So basically, that is that. These are the advantages that you can have without having fear. All right, you have security, you have identity card. So basically, one place you can invest in, a location incentive is free zone. All right, you need to conceptualize this and keep it in you, because it's not something you can afford to forget. All right. Then we have accommodation at site. Accommodation at site. What do we mean accommodation at site? I mean, in employment income, and listen to this carefully, because if you are operating in these industries, this one, such as timber industry, mining, building, construction, farming, petroleum operation, if you have been given an accommodation, proximity to site, accommodation, proxy to site, to the site of your operation, then it means that your rent allowance or your rent, the rent part of your salary is exempt from tax. It's exempt. But hold on. This instance is when the organization gets you the building or gets you the house. But if the organization gives you the employee cash and you use the cash to go and rent, please, it is taxable. But if the organization pays directly, then it is what? Not taxable. But if the organization gives you cash, then it means it's taxable. So please take note of that. That is it. And the thing must be proxy to site. If it is not proxy to site, forget about it. So location of field operations. So please, that is that. So the thing must be proxy to site. Number two, it must be paid by the entity. Not the entity giving you the money, but the entity paying it themselves. But if the entity is rather giving you the money for you to go and pay, please, it is taxable. So take note of that. So that is that. So that is the second thing you need to know. Then we have location rule that differ from residents and non-residents. We all know, in fact, you need to understand resident. We will talk about it later in the course. Residents. When we say somebody is resident in Ghana, Section 101 talks about residency, and we will later look at it. So basically, if you are a resident in Ghana, for now, what you need to understand is that if you are a resident in Ghana, so far as you are a resident in Ghana, it doesn't matter where you earn your income, all right, you pay tax. So what is a resident? That is why I say we would look at later. But for now, what you need to understand is that so far as a person is resident, please, we didn't say citizen, no. We say resident. A resident, and by definition, for now, what we can say is that for somebody, for now, somebody who has stayed in this country for more than 183 days. All right, 183 days in aggregate of 183 days. All right, aggregate of 183 days. It means that that person is a resident. And if you are a resident, it doesn't matter where you earn your money. Your money can be earned in Cambodia. You still pay tax to Ghana. All right. So we will look at what residence means later. But for now, understand that so far as somebody is a resident, it doesn't matter where he earns his money. All right. It doesn't matter where he earns his money. However, there is an exemption. You see, the exemption is that, the exemption is if you are, for example, in the first place, I said that if you're a resident, so let's say I'm a resident in Ghana, it doesn't matter, and I said that resident means that probably I've stayed in Ghana for 183 aggregate days. All right. Ending and starting and ending in a year of assessment. Now, what this means is that if so far as I'm a resident in Ghana, if I earn money in UK, I need to pay tax to Ghana. So that is it. However, if I'm a resident individual, so it says that it exempts income of a resident individual from employment exercised in foreign country. So if I am taken to UK for a period of, let's say, more than 183 days, and I work in UK, okay, and I'm working for a foreign person, or maybe a Ghanaian that employed me at UK. I may be resident in Ghana, because one of the definition of resident in Ghana is that a citizen, other than one who has a permanent home outside Ghana and has lived in that permanent home for the whole year of assessment. So look at it, a citizen, other than. So it means a citizen is a resident. But I can be a citizen of Ghana, but I am employed in UK and I'm working for somebody in UK. And the sole reason why I'm in UK is to work for the employer who employed me in UK. In that case, even though I am a citizen and I don't have permanent home in UK, my income tax will still, my salary will still not be taxed in Ghana. I hope you understand. If you don't understand, let me know. Let me clarify where you don't understand. Your line is very bad, Thomas. I think you need to put. Yes, any question apart from Famous, whose line is not helping? Yes, any question? Any question? Famous, you can try again. Let's see.
Well, I was saying that if you could come over there, you can just go over the last statement.
All right, so this is the whole thing. If you are a resident, it doesn't matter where you earn your money from, you pay tax. Do you get that one? Hello?
Yeah, I'm okay with that one.
All right. And who is a resident? There are 4 things that define residency. 4 things. Among them is one that says that a citizen, all right, a citizen other than one who has stayed outside the country the whole year. Listen carefully. A citizen other than one who has stayed outside the country the whole year and has a permanent home outside Ghana. So it means that if you are a citizen and you have your permanent home in Ghana and you have stayed anytime in Ghana, then it means that you too, it doesn't matter where you earn your money from, you are supposed to pay tax because you are a resident. However, we are saying that because your employer is outside Ghana and you too, you are outside Ghana working for the sole purpose of your employer, you will not pay tax even though you are a resident. That is what the exemption is saying. Is it clear now?
Yeah, it's clear now.
All right. So basically, that is that. So in effect, if a job can be done in Ghana as well as Switzerland, one can arrange the employment in favorable terms to benefit from tax exemption. Because if the thing can be done in Ghana and at the same time in Switzerland, if you stay in Ghana, you pay tax. But you can be moved to Switzerland and not pay tax to Ghana. The question is, oh, but say you also maybe pay tax to Switzerland. That is not the focus of tax planning. We are looking at Ghana in context. Switzerland is a tax haven country, so the tax may be low. It's a tax haven country. So that is that. So another place you can also benefit from location is the tax havens, like the islands, all right, and the Switzerland example that I just gave. So if it's like that, then why not go there and do the job in Ghana? You will sit in your Switzerland place and you'll be working in Ghana. So that since Switzerland is a tax haven, the tax is low, and Ghana will also have no opportunity to tax you. So basically, that is that. Then we have a manufacturing business. I've already mentioned this one, that a manufacturing business that is located in Accra Tema pays 25%. Any other regional capital is 18.75, meaning you have a rebate of 25% on this one. Then any other place outside regional capital, you pay 12.5. So that is for a manufacturing entity. Then if you are agro processing company or a farming in a farming business, these are your location advantage. Location advantage. If you are in Accra Tema, you pay 20%. This is farming agro processing, but manufacturing is 25. But in this one in Accra Tema is 20%. Regional capital outside the Northern Savannah Ecological Zone. If you do you know the Northern Savannah Ecological Zone? I think now we have a Savannah region, right? But in the context of the law, this is Northern region. All right, all the regions in the Northern region, the old Northern region, they are the regional. So if you're a regional capital outside the Northern Savannah Ecological Zone, for example, if you are in Kumasi, that is not in Accra Tema. If you are in Cape Coast, if you are in the other regional capitals, other than the Northern Savannah Ecological Zone, your tax rate is 15%. Outside the northern, outside the area, any other area outside the Northern Ecological Zone, i.e., like that place is not a regional capital, is 10%. Then if you are actually in the Northern Savannah Ecological Zone, that one you pay 5%. So basically that's that. The next one is a young entrepreneur, someone who is 35 years or below. If you invest in any of these sectors, look at the sectors well: manufacturing, ICT. Please, ICT is like a software developer. Agro processing, energy production, waste processing, tourism, creative art, like the Shatawale people and things, horticulture, and all these things. You are exempt from paying tax for 5 years. 5 years. 5 years. So if your old man is going to establish a business, let him use your name for it if you are that young, so that you won't pay tax for 5 years. And after your 5 years, if you are located in Accra, Tema, it's 15%. As other regional capital outside the 3 northern regions, 12.5. Any other regional capital, 10%. Outside other regional capital, 10%. And if you are in the 3 northern region, 5%. So this is location incentive. In the location incentive, I have looked at 7 issues. So try and remember most of them. What are the things you would remember under free zone? Yes, anyone, free zone. What do you remember? The things we said under free zone. If you are located at free zone, yes.
They are exempt from tax for 10 years.
That is a wrong statement.
From income tax, sorry.
Yes, what else? What else?
So after the 10 years, your chargeable income tax is 15%. That is for exports. And then of domestic is 25%.
Okay.
And also if you export,
I'm listening.
that's 70%. I've not written it to.
It's a must that 70% of their production should be exported and 30 should be local. Yes, any other thing? Who remembers any other thing under free zone? Because you cannot dodge free zone in your exams. Yes, please.
Yes. So, what if the nature of the market does not permit the 70/30?
And write to the Commissioner General. How can the nature of the market not permit 70/30? Ghana wants more export, so how can we not want you to export?
Maybe because of an event like, let's say, for example, COVID-19. So, something similar happened.
To every law there is exception. This thing you are
So,
talking about is a national disaster. It's a world disaster, so it is not a normal situation.
okay, what if, let's say, the demand for that particular product outside the country goes down?
Then why do you have a marketing department?
Okay.
And you cannot give excuses like that now.
So we say that they are also when it comes to VAT, they are zero rated.
Yeah. That one is true. What about the shareholders?
The shareholders are also exempt from withholding tax on their dividend.
Okay. What about ownership? So you have to learn these things. Like
Yeah.
that's how you have to learn. It's very, very important. All right. So
The,
basically, at least it is good that you remember something small. So let's go to the activity variable, which I have quoted like more than 14 points. So you have to remember at least it's more than 14 if I remember. It's 14, yeah, it's 18 points. So activity variable. So I've given you 18 things. So you should be able to remember some of them. Now let's look at the activity variable. Activity is what you do, like the business you're actually doing. All right, and the tax incentives surrounding it. So if we look at the activity variable, we look at the farming business. Now, in a farming business, we know that what is farming? Farming is just production of crops, rearing of animals, and fish farming. All right. So basically, that is that. Now, what will happen is this. If you are doing a tree crop production, tree crop, no tree crops, these ones, you have, and please take note of this, it's very, very important. It is 1%. You'll be paying tax for 1% for 10 years. And please, I'll give you a caveat because this 1% changed. It changed. It changed in April 2023. But your exams that you are writing will be in November 2024 as we speak now. So depending on the date of the question, you have to apply the particular one. Because it actually changed. And from May 2023, this is when the law was actually brought into being. The 1% changed to 5%. So take note of the timing of the question. It's very, very important. Take note of the timing of the question. Very, very key. All right. So take note of that. So all the 1% that I'm going to mention, it changed in April 2023 to 5%. So depending on the timing of the question, you have to apply the rate. If this book is to be reprinted in next year, this 5%, 1% will be out. But you are writing your exam in November. So be very careful. All right. So if you are dealing with tree crops, you have 1% for 10 years, commencing from the year during which first harvest of your crops occur. So tree crops, you have 1%, 10 years. When is it commencing? Year of first harvest. Take note of that. Very important. If you are doing farming of livestock other than cattle, which means livestock apart from cattle, your tax rate is also 1%, and i.e. 5% from April for 5 years. But when do you start? Business commencement. So that is that, starting from business commencement. So you can be given a question for you to analyze the timing. Be very, very careful. So business commencement is important. If you are doing now a cattle, it is 1% for 10 years, also starting from business commencement. You need to memorize these things. So all you need to do is that tree crop 1%, 10 years, year of first harvest. Farming other than livestock, 1%, 5 years, business commencement. Cattle, 1%, 10 years, business commencement. All right, so that is that. But the 1%, 1% I'm talking about changed in April 2023. So be careful. All right. Agro processing. If you are into agro processing, those who convert the farming activities into edible canned product or packaged product, for them to, it is 1% for 5 years, but it is commencing from the year of commercial production. Commercial production. Again, the 1% changed in April 2023. So be careful. So that is that. For cocoa byproduct, I mean the cocoa husk and all those things, you have 1% for 5 years from the year commercial production also begins. All right, so that is that. You are in the banking sector, rural banking specifically, it is 1%, 10 years, starting from when you commence the banking business. Then we have 1% for 7 years, starting from when you commence a waste processing activity. So those who convert the waste process, recycling and all those things, those are the things. Residential premises, please, this is more of affordable housing. You have to prove that you give your construction at an affordable prices. These things are subjected to the judgment of the commissioner and the Ministry of Works and Housing. And that one, if it befits that you are using it for affordable residential premises, then it is 1% for 5 years of assessment, commencing from when you commence your operations. So take note of that. We spoke about a young entrepreneur, and we said that if a young entrepreneur is into communication, ICT, horticulture, creative arts, medicinal plants, we said that you won't pay tax for what? 5 years. Don't forget that. That is also the activity. Approved trust. All the trust people, they are exempt from tax indefinitely. So all the trust fund, trust this, mutual this, do all those things, they are exempt from tax indefinitely. Then we have venture capitalists. If you know a venture capitalist, these are people who support small enterprises to bring them up and let them get grounding for a stake in their ownership. Now, if you qualify as a venture capital, all right, there is a law that governs them. If you qualify as a venture capitalist, you also have 1% for 10 years, commencing from when you first qualify as a venture capitalist. All right, so basically that is that. That is point 10. Now, in point 11, it's very interesting. Now, so you see, I said, note, all concession rates are now at 5% from April 2023. Take note of that. Then we have point 11, employment of fresh graduates. This one is something you must take note. Who is a fresh graduate? A fresh graduate is somebody who is being employed for the first time from a tertiary institution. So I always say, if I have masters, if I have first degree, I went to a university, and probably I go to a university again. The moment you employ me, I'm a fresh graduate. It doesn't matter if I was employed before. So the law says that whether or not that person was previously employed. So far as I have left the tertiary, if first degree, first employed, I qualify. Master's degree, first employed, I qualify. PhD, come out, I qualify. So if an entity employs you, the entity is exempt. These are the benefits. If the fresh graduates are up to 1% of your total staff, up to 1% of your total staff, then 10% of the wages and salary are given as exempt. So somebody will ask, say, is it wages and salary for the entire company or wages and salary for that fresh graduate only? Those fresh graduates only. Please, it is the wages and salary for those fresh graduates only. If those people are above 1%, but not more than 5%, you get 30% of the wages and salary. If they are above 5%, you get 50% of the wages and salary. So these are exempts that get. It is good for the SMEs, but not much more for the multinationals. All right. So that is that. And we spoke about free zone. We said that somebody who is in a free zone activity is exempt from tax for the first income tax for profit for the first 10 years. Importers of, yes, please.
So this fresh graduate thing, is it really working in our system?
It
Because
does work. If you don't know, you don't know. It works, Papa.
some of us were employed, I mean, after school, but we never benefited from this.
It's not for the staff, it's for the entity. It's not for you, the staff, to benefit. It's the entity that is employing the fresh graduate.
Okay.
Yeah, so it's not, it will not reflect in your salary. It will reflect in the employee's profitability. Automatically, if the profitability increases because of these tax exempts, then it will reflect in your bonus. So that's that. Now, we are talking about importers and exporters. These people of exercisable goods, these people receive accelerated capital allowance for 2 years. It means if they buy a machine, they will recoup their money within 2 years as capital allowance. We will do capital allowance, but I encourage that you take the lead and watch my video on capital allowance. Very important. And withholding tax. These are compulsory videos you must watch. All right. So take a lead on that and watch that. All right. So that is that. So first year 50%, second year 50%. They get capital allowance. Now, private universities are exempt from tax if they can prove that they use their profit to improve the school. They plow back 100% of the profit to improve the business. We've already talked about non-traditional exports. They pay 8%. All right, so that is that. Then financial institutions for farmers and leasing companies. So if you're a financial institution, you provide money for farmers. you give loan for farmers, you lease loans granted to leasing companies for them to use as funding to acquire assets or lease assets, then it means that your tax rate is 20%. Hotel businesses, 22%. Now listen to the last one, because the examiner has been tricking people on that. The income of a cocoa farmer from what? From cocoa, not from any other business. The income of a cocoa farmer from cocoa, not from any other business, is exempt from tax. So if they say a cocoa farmer is selling chocolate, let's say he's selling let's say tea roll, and he's getting profit, you don't say he won't pay tax because he's a cocoa farmer. The one that he doesn't pay tax on is the one from the cocoa farming. So take note of that. All right. So that is the activity variable. Then we come to the time variable. The time variable. You've heard the aspirant presidency of the MPP saying that when he comes, he will give some tax amnesty. Tax amnesty is something that comes once in a while. The whole Ghana, it has happened 3 times. Yes, since constitutional days, that's happened 3 times. So tax amnesty comes so that you will be allowed not to pay interest and penalty on your defaults. So it means that when an opportunity comes for something like that, you will have to take or make good use of it. That is a time tax planning. You are reducing your tax liability because you are making usage of the tax amnesty. In Ghana in 2017 it happened. In 2021 too it happened. I think they said I've forgotten the first one, but these two I witnessed them. So when it happens like that, you just make good use of it to reduce your tax liability, because other than that, you are going to pay interest and penalty. All right. So that is that. Then we have this one, section 46 of realization. I'm going to skip that one because you won't understand it until I explain it. So you said in the book, I said refer to the work example in chapter 6, and we will look at the issues at realization. We will look at that, the issues at realization. We'll be looking at it. All right. So basically that is, I will explain it later. But the capital allowance one, I will explain to you now. I'll explain to you now. Now watch this. In Ghana, you get capital allowance. You get capital allowance. Hold on just a minute, please. Now, you get capital allowance when you own assets and the asset is used in the production of an income. You get capital allowance for that. So if you own an asset and the asset is used for the production of an income, you get capital allowance. But in the year that you don't own the asset, you will not get capital allowance. So get to understand the thing. If you own the asset, you use it to produce an income, you get capital allowance. If you don't own the asset, and that one you won't get capital allowance. So watch this. If I buy an asset on it, or I have an asset and I sell it on December 31st, 2023, will I get, if I sell my asset, will I get capital allowance for 2023? Per what I said earlier, will you get capital allowance for 2023? Hello? Anyone? Jane, are you there?
Yes, sir.
So what do you think about this?
Yes, you get capital allowance for it.
Why?
Because it was in use throughout the year and it was sold at the end of the year.
But I said if you don't own the asset in the year, you won't get capital. So if you sold it, why should we give you capital?
But you owned it for the year.
You didn't own it you sold it to this year, this time. So in a part of the year, you weren't owning it.
Okay.
Because by the time the year ended, did you have the asset?
No.
And so why should they give you capital allowance?
Okay.
The law says in the year you don't own the asset, nobody will give you capital allowance.
Okay.
But if you bought an asset on, let's say, 31st December 2023,
Okay.
and you use it, will you get capital allowance?
It's best December. Yes.
So have you seen the differences? Just a second. So, Jane, you answered and said that since the asset is bought on this date and the asset is being used, it means that the person can get capital allowance, right? But
Yes,
if he
sir.
sold it at the end of this period, then it means he can't get capital allowance. Now,
Yes,
if you are the tax accountant in your office, what do you think a company should do? Sell assets at early in the year or sell at the end of the year? Buy assets at the end of the year or at the beginning of the year? What do you think the company should do?
Buy assets at the end of the year.
What about selling?
You sell at the beginning of the year.
And that is the tax planning activity. Do you get it now?
Yes, sir.
So if you are in a company where they are selling their assets at the end of the year, you are the person who is supposed to inform them.
Well, I
Right?
say,
Yes, please.
won't there be any form of consideration in relating to, because I know that when it comes to that, at least there are 3 conditions that must be met, and being that the asset must be used in the production of either goods or services. Don't they consider that when we are looking at when to buy and sell the asset?
You said there are 3 conditions.
I know that for you to apply for capital allowance, I know that though we said the asset must be,
Those are the
must
conditions.
be,
The asset must be owned by you by the
yes.
by the year of end of the year of assessment. The asset must be used in the production of an income.
So I'm saying that since we are looking at when to sell the asset, when to buy, if you should buy an asset at the end of the year, won't there be consideration of looking at it if that asset actually be used in the production of goods and services?
Of course, if I buy,
within the year?
You can't ask me whether I bought the asset at 11:59 p.m. 31st December. Is there something like that?
No.
So if I bought the car and I drove it to pick something, it is in use on that one day in 31st December, it means I've used it. I don't know. I don't know if you get it.
I understand you.
No, the law is the law. I can, if you want me to say November, I can use 30th November. That one to what will you say? And sell this one 30th November. If you sell at 30th November, you won't get capital allowance for the asset in that year. Do you understand?
Yeah, okay.
Because in that year, you didn't own the asset. Is that okay? But if I bought it 11th November, are you telling me, can you say you won't give me capital allowance and that I did not use it for December?
See.
No.
All right.
You get the point. So that is it. So the timing of buying the asset and selling the asset matters a lot. It matters a lot. But there is a caveat on it when it comes to realization with replacement. We will look at that, and the day we will look at that, I will remind you of this meeting. All right. So that is that. So we will look at the entity variable later, because the entity variable, we are going to look at the 4 entities of a business. So the what do we call it? The sole proprietor, partnership, company, and trust. So we are going to look at how we tax these 4 institutions. So that is how it will be, and we will do that most preferably Saturday. All right. So that is when we will do that, the taxing of the entities. All right. So basically that is that. All right. So these are, we've done at least the location, we've done the activity. So if I ask you farming activity, can you tell me the planning, the incentive activity, incentive percentages that are there for concessions? Farming, where we classified it into 3. Anyone? Which one do you remember? You've forgotten all of them. Hello, are you there?
Yes, sir.
Yeah, which one do you remember under the farming?
So please, actually, when you were explaining that one, I wasn't really paying attention. I
Okay.
was still in the office, so
Any other person? The farming, what is the incentive there? The concession?
Network want to.
You said what?
As a
3 crops, 1%.
my
Esther is talking. Let's hear her.
okay.
There was 3 crops where the tax rate was 1% before April 2023 for 10 years, commencing from the first harvest, I think.
Yeah, so that is it. But you have to make sure you remember all of them. That is the challenge, but that is the exam. So you have to, because you will see later on that. Let me show you something before I end the class. You will see when we are done, we will go into the past questions. And these are the past questions. So this one, for example, explain the concept of prison. Explain 2 policies rationale for the establishment of prison. Now, so there are questions that you need to answer. So when you are learning it, you have to be very, very careful. Now, again, you see something like this. You see this one. You see the compute the tax payable for each of the company. Explain the tax incentive that they enjoy. You see, this is a manufacturing company, and this is their profit. How much percentage will you apply for this? It is located in Accra. What percentage will you apply? Activity variable. What percentage will you apply? A manufacturing company located in Accra. What percentage will you apply?
It should be 25.
Tema.
25.
Kumasi.
18.75 also.
So you have to learn it well. It's good. You are getting it. Body. Do you know where body is? Where is body? And what percentage will you apply?
Body, I don't know. I don't know what it is, but I think it should be 12.5.
Exactly. Then I am fury.
The name alone is 12.5.
So that is it. And look at this one. Agriculture. It is established 20 years. Established since 20 years. Which one will you apply?
20 years. Agriculture, we said 1%.
You see, that 1%
for
had
10
a
years.
limit. It had a limit. it says since 2010. And this thing you are doing is 2022. So if it is 10 years, it's 10 years will elapse when? Is it not 2020 or 2019?
Yeah.
But this is 2022. So which rate will you apply? And they didn't give
So
you
after
the location. So you see,
if they didn't give the location, we assume that is 12.5.
Why not 25%?
Farming usually takes place outside Accra. Usually.
It usually takes place outside Accra. All right. Oh, the reason why I'm showing you this is that when you are learning, you pay attention to it, not like you are just reading something and letting go. All right. So basically that is that. So that is the first questions you go through. Distinguish between tax avoidance and tax evasion. So please, that is how it will be. All right. So, and I provided the solutions also in the manual, and so you can have a look at it. All right. As for tax, if we finish like this and you go through the past questions, it is possible you can even get 90%. Yeah, because it's law, and law is the same thing we all do. All right. So we will continue on Saturday. All right. We'll continue.
Okay.
Saturday. Thank you very much.